Be prepared for a 37% decline in the markets. 50%, not so much, but 37%, yeah, sure. So we're going to read this article from my man Ron Surs over at Advisor Perspectives. A big fan of old Ron here. It's just a great piece that I tell you, it's critical for you to understand. All right, so we're not going to talk about bonds. Bonds are easy. So stocks are complicated. Stock prices are above historical norms based on a variety pack of measures like PE ratios. That's all we care about is PE ratios. The other stuff I don't care. Prices, of course, continue to go up, but what if prices return to more normal levels? The question is answered by this table right here. And we're going to dive into this table because there's a flaw in here, but he's still spot on. There's a formula for estimating future returns that always works because it has to work. Return equals dividend yield plus earnings growth times your increase or decrease in PE. So your P, price to earnings expansion or contraction. Critical. This third part of this formula is actually critical. Returns equal dividend yield plus earnings growth plus or minus your increase or decrease in contraction of price to earnings. And that simply means for every dollar of earnings, are people willing to pay more or less for that dollar of earnings? All right. And this is where I take some issue with Ron. All right. So as you can see from the green shaded area right here, all right, stocks will continue to earn positive returns if PE multiples remain near current levels and earnings grow by more than 6%. Momentum will save the day. But the markets will lose 50% if PEs return to their historical mean of 15 and earnings grow at their historical average of 6%. And then Ron says, what's your outlook for earnings growth in the stock market over the next 12 months? And exactly what I said. We're going to look at this table because this is critical. And so what he's doing here, well, I completely agree. He's saying we are currently at a 30 PE, and that's my big challenge. If earnings continue to grow by 6% year over year, and we maintain a level price to earnings ratio, we'll actually have a negative rate of return. All right, maybe. And I challenge that to some regard, but let's just be it as it may. All right, now he says if earnings grow at 8% year over year and we maintain our current PE ratio, we'll have a 0% rate of return. And this other stuff is silly. We're not getting 14 and 24% earnings growth. The problem I have, the fundamental problem is pricing the current price to earnings level at 30. I don't price to earnings level. I don't find that to be true. And so I looked at what is the current PE ratio of the S&P 500. And basically, we're using the charts that show a 29.5 estimate at current price to earnings ratio. So 30, which is where Ron's saying. And this is the same. It's not, man. It's not 30. So what's happening here is at the beginning of January, we had a current PE ratio of 35.96. Now we have a current PE ratio of 29. How is that changing? Well, the problem that we're using is we're using the end of the year earnings and we're extrapolating the current, literally minute by minute price on the end of the year earnings. And it's making, because the earnings haven't changed from the last year yet in terms of this metric we're using, but the prices have, is showing a significant higher PE ratio than what's actually happening. It is. And it's just like I said last year. If you looked at in the March, the PE ratios are 4 and 5. I said, but that's not 4 and 5. I mean, it is, but we're looking at the end of the previous 2019's earnings, and we're extrapolating that to the current price. And the price is based on future earnings projections. And the future earnings projections, because of the pandemic, were quite low. And so the price fell through a cliff, fell through the floor, because like, man, I'm not going to pay $1 for $30 of earnings when I don't think there's going to be $30 of earnings. I think the earnings are going to drop through the floor. And as such, I'm going to be selling, which is exactly what happened. Now, that turned out to be bad, but I'll never forget saying people are pricing the S&P like it's the cheapest since 1982. And it wasn't. It wasn't. Because they're looking at the trailing 12 months of earnings from 2019 and extrapolating that going forward. And you can't do that. I mean, you can, but it doesn't make sense. And the same thing's happening in the reverse here. We're taking our lower prices from the last year, January 2021, and we're putting it in current, we're putting it in relative to earnings, and we're putting current prices relative to the last year's earnings. And two completely different metrics. Anyway, so what I want to share. So I said, okay, let's what is the current PE then? And we're going to find out. I'll show you. There's VOO, which is up to date on price, 24.09. So basically 24 is the PE ratio. Up to date on price, but the trailing 12 months of earnings is from September. I know this is confusing. It's just, there's no way I can explain it better than what I'm trying to do here. Just we're extrapolating last year's data on earnings and we're putting current data on price. And it's just not a fair assessment. So the PE is 24. On VTI, the PE is 23. All right, but let's keep going back. So then we're going to say, okay, so Ron says if we have a current 30 PE and the price fell, the PE went to 15, well, that's a 50% decline. And we simply do this. We know it's pretty easy, actually. The math on this is quite easy. We say, so we haven't changed our price to earning. We haven't changed our earnings. Our earnings staying flat. But the price people are willing to pay for that flat earnings has dropped by 50%. So we just basically do 15, divide by 30, and we have a 50% decline, all right? But actually, we're actually not at a 30 PE. We're actually at a 25, or actually a 24 PE. So we do 15, divide by 24, and we get not a 50% decline, but we get the exact 37% decline, if that makes sense. All right, so this is what we're left. So if the prices fell from 24 to 15, which is a historical normal for price to earnings ratio, we would lose 37%. We retain 62%. Now the VTI, which is why you need a B in it, is actually 23. All right, so if prices fell from, hold on a second, prices fell from 23 to 15, we'd retain 65% of our capital or lose 35%. All right, that makes sense. Now, what if PE went from 25 or actually 24 to 20? How would that shake out? Well, we go, if we lost $5 of earnings off a, what did I say, Jerry? I think I said 25. We got to go to 24. So we lost $4 of earnings off a 24 PE. We would lose 17% of our capital and we retain 83%. I hope that makes sense. So basically what I'm saying is if we're at 20, and if you're in the VTI, and you basically say 20 divided by 23, you would lose, what, 15%? 13%. You retain 86.9% of your capital. All right, so here, if we're at 25, for simplicity, we're at 25 is our current PE, and it fell to 20. All right, you would lose 20 divided by 25, was that 20% of your capital, I think. Yeah, 20%. You would lose 20% of your capital. So if we are currently at 25 price to earnings ratio and the PE contraction went down by 5, you would it essentially went down by 20%. You would lose 20% of your capital. That's assuming we got 6 year-over-year earnings growth. And I don't think you can make that assumption at all. So what I'm going to say is we don't have a 6 to earnings year-over-year earnings growth. We're going to actually have a 4 year-over-year earnings growth, or even a 2. All right, so if we have a 4 or a 2, you can see we're still going to lose. If we're at 25, we go to 15, we'd lose 37%. All right, but if we're at 25 and we go to 20, we're going to lose 15%. I hope that makes sense. But if we have a earnings growth year-over-year decline of 6 to 4, we'll lose about another 2 or 3%. So that's where I'm getting you. Like, you could have a 37%. That's a pretty extreme loss in price to earnings ratio. I don't expect that to happen. That's a 50% decline in PE ratio. I more expect, or a 37% decline in PE ratio based on earnings staying the same. I don't find that to be feasible. I could easily see a PE ratio decline of from 25 to 20 with an earnings growth declining from 4 to 2 given the inflationary numbers. So the 37% is pretty extreme. And that's what I use that in my data. Hold on a second. The 37% is my worst case a la 2008. And my models on 100% stocks, I have it actually looking at about a 42% year-over-year decline as worst case. Now, that's 100% stocks, which is worse than what happened in 2008, by the way. But let's look at old Wellington. I'm not sure if we can see a PE on Wellington. Let's check it. Oh, no. What we'll do is look at VTV. Hold on a second. So here's VTV. We're at only a 17 PE ratio, which is why I'm fully engaged in VTV, and you might want to think about this as well. So look back at Ron's chart here. 17 off of 15, that's only a decline of, we go to 15 divided by 17. I don't even know what that is. Not going to be much. It's only a decline of 12%. And that's 100% stocks that's just value-oriented stocks that have a low PE ratio. That's the point about the value stocks, man. The value stocks are low. And then if you look at Wellington, which has bonds in there, it's not even going to have a 17 PE. The point being is I think you should look at 37% decline as possibility if you're 100% stocks. 100%. I think 50% is too much. No, it could be wrong. But I think 37% is actually spot on, a la 2008. But again, 2008, Wellington was only down 22% in 2008. I don't know what VTV was off the top of my head. I just don't know. But if you're looking at the current PE ratio, and the prices dropped relative to our earning decline, the value stocks aren't trading at significantly high prices anyway, so the drop would be less. It's just that simple. And look, anyone could be wrong here. Anyway, so I commented on Ron's thing because I like Ron. I just said I don't get how you're showing a PE of 30. I get it if you're using trailing 12 months as of 2000. I should have said 2021. Let me edit that real quick. As of 1/21, right there, not 2020. Boink. But using trailing 12 months of September 30th, the PE is around 24, which is what I think you should use. The PE is thus if earnings stayed at 6% year over year, the downside is 37%, not 50%. Still bad, but don't get me wrong, but we're right back to 2008 decline. Certainly not a once in a century decline as before, as 50% would be. Anyway, point being is the PE ratio is a big deal, but that means the value stocks on a downside market potentially could provide you more cover. Hope this helps. I know it's confusing, but I'd like for you to think about that and comment. All right, we'll see you.